All right, so let's bring the guests in here because we want to know if inflation is becoming a real concern for an already weak economy. That's just one of the questions, actually, we'll tackle in this economic roundtable. Joining us from Philadelphia is Bill Dunkelberg. He is chief economist of the National Federation of Independent Businesses, and Stephen Stanley is chief economist at RBS Securities. He joins us from Stamford, Connecticut. Gentlemen, welcome to the show. Why don't we start out, Bill, by talking about the survey that you guys have put out this morning. Kathleen and I talking about it this morning. Some interesting sort of an up arrow here and a down arrow, but we thought the most interesting thing to take from this was that you predict unemployment will come back down to 8.8% in the third quarter.
Yes, indeed. The good news was that the labor market indicators became less negative. Look how we're scrounging for good news. You know, less negative is good news. But we have a model we plug these data into, and it's a very reliable forecaster of where the unemployment rate goes. We had a forecast of 9.3 for the second quarter. I think officially it's 9.2. So we have it going down to 8.8 into the third quarter, and that's very good news. And those pieces of our survey said that things are getting better. Owners did get a little more pessimistic about sales growth, and of course that's one of the issues we're talking about, retail sales. You know, they still are looking for customers.
Stephen, what do you think? I mean, is it likely that we go down to 8.8%? I mean, that would be great news for the economy going forward, great news for the administration, but it doesn't seem like a lot of other indicators are pointing to a drop to that.
Yeah, well, first let me just say, I think Bill does a great job with that survey. I mean, it's a really important indicator. We pay a lot of attention to it. You know, in terms of the unemployment rate itself, I mean, I think Bill's indicators are pretty consistent with what we're seeing, which is that the downturn is starting to abate. That being said, you know, our guess is that the unemployment rate is going to probably drift higher for a while at least, and may get as high as 10%. But you know, I think we've seen kind of a classic, you know, extreme swing in psychology. Everybody got really excited about the labor market after the May payroll numbers showed a smaller decline than people in.
Looks like we have some technical difficulties there with Stephen's shot, but we still have Bill with us. Bill, what do you think? I mean, it just looks like you say that plans for inventory investment and capital spending back down a bit, and this seems like it would be more of a down arrow, more of a negative for the employment picture.
Well, a little bit, although I'm not sure that employment really is dependent on capital spending right now. What we have seen is that small business owners, and of course the big businesses too, apparently, have really gotten rid of the inventory. The shelves must be really empty now, and of course, going forward, that's got to be some good news. I mean, there can't be any cars left on the lots out there, or maybe there are some. Maybe that's why car prices are starting up. You know, once we cut prices way down low, we could see some quick pressure on prices to move them back up. I guess we'd call that inflation, but the price level might still be quite low. So real wages haven't done that badly, given that inflation's been negative for the last year.
Stephen, I want to bring you back into this, particularly on this question of inflation, because it's easy to say with the producer price index on the headline that was a lot energy prices. You see the core up, and in fact the core is up about close to 3% on a year-over-year basis, while the headline has fallen. Where do you stand on this? Inflation, is it really a problem to debate at this point? Are you with the worriers, or are you with the people who say don't worry?
I'm probably more with the worriers, but more worry later rather than right now. I don't think we're going to have an inflation problem in the near term.
All right, looks like we lost Stephen there again.
So Bill, you pick that up, because the same question to you. One of the very important questions you ask in this monthly survey, which Stephen, as a Wall Street economist, says he watches closely, are people raising their prices? Are they cutting their prices? You know, what are they having to pay themselves? What do you see from your survey?
Right, and our numbers, of course, indicate that the number of firms cutting prices are 20 percentage points more than raising prices. We've never seen price cutting like this in the 35-year history of the survey. So, you know, prices are down as low as we can get them. But again, you know, once we're there and going forward, if we're moving up from there, I guess we'd call that inflation, even if the price level stays low. But right now, sales are down. And one reason sales, by the way, are low is not because the quantity being sold is low. Well, that is too. But also, when you cut prices, remember, revenue is P times Q. And if you're cutting P and cutting Q because no customers are there, retail sales aren't going to look real strong for a while.
I wonder about, you know, since we are talking here small businesses, and we hear all the time that small business really drives job growth in America, let's address that first. Is that the case from your perspective?
Yeah, that's, you know, we've been studying this for 20 or 30 years now. And, General Motors doesn't generate a lot of jobs even when it grows. It's a capital-intensive firm. They use capital, not labor. The small business sector dominates the service sector, so they need a lot of labor. About 80% of our costs are labor costs.
All right, Bill, hang on a second. We're going to take a quick break. I want to talk about that, though, especially in regards to CIT and that story today. We're back in 2 minutes with more. All right, we are back right now with Bill Dunkelberg. He is the chief economist at the National Federation of Independent Businesses. Stephen Stanley of Royal Bank of Scotland of RBS Securities, the chief economist there. We had technical difficulties, so we lost that satellite feed. However, we're happy to have Bill here because I want to talk, and Kathleen Hayes is still here as well. Thank you, Kathleen, for sticking with us. I want to talk about the small business job situation because, Bill, as you just illustrated for us, it's really the driver for U.S. job growth, and it doesn't seem like we're seeing the administration really reach out to these small businesses in the ways that they possibly could, especially with the stimulus program.
Well, that's right. The stimulus program really didn't have anything in it much for small business, a little bit of more on depreciation, a little bit more on spreading your losses, but really there was no direct stimulus there. You know, if you think about the $50 billion we put into General Motors, you could have given 5 million employers a check for $10,000, help them get through this long recession. I mean, there are a lot of ways you could have had a stimulus, including having a 6-month tax hiatus for FICA and income taxes. That would have put a lot of money in right away, and that would have been very helpful. But, we're the ones who do create the jobs, but we won't hire new people until we see customers, so that we need to have somebody there to help them. And that's really the issue. What did the government do to get customers back? And the answer is not very much.
Well, and then this is a debate that's going to have to be, settled by professors like you, which you also are, Bill. But what about CIT, and what about the notion that if the government doesn't prop them up and guarantee their debt and keep them running, that this is going to be a very serious blow to small businesses in general and the economy as well?
Well, I think that's the case. And, of course, there are other finance companies that might be blemished if CIT fails because people will just worry about them. But CIT is huge. It's, covers the whole U.S. It's got hundreds of thousands of retail clients. It's got 1,000 manufacturing companies that depend on it to help them with their cash flow. So even if all those people could go refinance if suddenly CIT cut them off, and they probably couldn't, we'd probably lose some firms. Just the business disruption, I mean, if your mortgage has to be repaid immediately, you can go get another one, but it takes time and it's painful in between. So we're really worried about the impact of that. There's certainly precedent that the government has for helping out finance companies, like GMAC, for example, or GE or whatever. So I think the issue is, do they pose a systemic risk? And and some people are probably arguing, no, they don't really. But really, they do to the real economy. That's the thing we care about.
Well, exactly. It looks like GMAC seemed to get help without anyone even asking about it. And here, I mean, what kind of impact do you think we could have if CIT went bust? You talk about 1,000 manufacturers, but also hundreds of thousands of retailers rely on loans from this company.
That's right. And right now, things are really tough. If you look at our profit numbers in the survey, we've got 40% of our firms net saying profits are declining. So cash flow is a real issue. Profits are a real issue. And if you can't get the funding that you need to help kind of tide you over through this recession, which we think is about to end, we'll lose some firms there if this credit flow from CIT is interrupted by a bankruptcy.
Kathleen and I talking about the job creations plans. That part of your survey is interesting. It's still a net negative 1% of owners planning to create new jobs, but that is a 4-point improvement. What do you think about the idea of things getting less worse? Because a lot of people seem to think that's not such a big deal, but it is better than things getting worse.
Absolutely. I mean, you can't go up until you stop going down. So the first thing you do is you stop going down. And we've seen a nice increase in the net percent of firms planning to create jobs, a 9-point gain over the past few months. We've seen job openings picking up. So that's really a very good sign. And again, plugged into our model, it says unemployment rates going down. So we're pretty happy about the numbers, and we think July will give us the positive numbers.
Bill, I just have to ask you, though, your data, your research also shows, though, that unemployment actual went much higher than your predicted unemployment rate back in the early 80s. Is it possible there's going to be another gap between what your work predicts and what the nation's unemployment rate actually does?
Kathleen, you're a good student of history. Very good. It did, and as best we can tell, that's because there were suddenly huge layoffs from the large companies, which of course are not in our sample, and consequently we couldn't really account for the amazing layoffs we saw during that period from the big companies. I think that's already done for us here now in this recession, so I don't think we have that upside risk. I think we're going to be correct and see the unemployment rate start to ease down.
All right. Hey, well, we all hope so. Bill, thanks so much for joining us. Bill Dunkelberg there of the National Federation of Independent Business.